time for Under 30. We are talking Chegg. So I'd like to welcome in George Tsilis, Senior Markets Correspondent for the network. And George, I have to say, I'm sorry. I feel like we're 2 for 2 with our names this week that are just tanking that we just discussed on this show. Chegg is obviously no exception, down 27% here.
Yeah, I think you're alluding also to SoFi, which I think was down, of course, on earnings on Monday. But Chegg also, stock sub $10 a share. We talked about this particular business overall, not necessarily because of the business risk itself. I think the challenge for Chegg, which is, traditional, textbook rental company, but they offer course assistance and, of course, academic support to students. They also have a small job placement division. But the challenge for this particular business is outside competition, particularly because of OpenAI and all the knowledge that's now available using artificial intelligence. That, again, maybe a different avenue for students to go to versus Chegg, which, of course, relies on premium subscriptions to generate sales, which, unfortunately for the company, did beat, but are still down or contracting on a year-over-year basis. But if you take a look in terms of the context, I mean, this is a situation where you have to really reflect in general on the growth of what's going on in sales and earnings versus the beat of sales and earnings, because they did beat on both sales and earnings, coming in at 26 cents versus 25 cents. Now, that was still down a penny compared to 27 cents last year, which isn't too bad. Maybe in the context of let's call it a 27% or so decline. But looking at the sales, they did come in ahead of estimates just by $600,000 at 154.7 million, but that was still down about 7% compared to the same quarter last year. Now, we talk about, companies all the time when they demonstrate contraction in sales and earnings, but it has to change going forward. And that's not the case here for Chegg, because if you look at the guidance for Q2, now at the midpoint, they're looking at 160 million. So that's even lower sequentially quarter over quarter than this last quarter, and down year over year. That's about 11% lower than the previous guidance. And with that said, this is the situation where if you, look at revenues, generally speaking, if they're down, let's say, 10% or so, they'll come at you for about 2 to 2.5 times that amount in terms of percent change. And if you look at the percent change, it's around 27%. So I would say that the movement lower reflects the reality of the situation for Chegg. Obviously, they need more investments and to compete with OpenAI. But I will say this, even though there's a bad decline, you'll actually notice the analysts are still denoting it more neutral or equal rate right around the $4 and $5 range, because this is a company that's not in a terminal decline, at least right now, because their balance sheet is sound. They have $330 million in cash on the books. They are profitable. They just don't have profit growth, and that's going to come from top-line revenue growth, which is unfortunately still contracting.
George, talk to me about how does a company like this adapt, right? How do they incorporate AI and turn it into something that's now seemingly creating a bit of a headwind for them to something that they can benefit from?
Well, in order for them to adapt, they're going to have to spend. And if you spend, obviously, that's going to increase your capital expenditures, and that's putting forward the profit growth of the business. So to answer your question, they have to spend. And I think that's, again, what we're seeing in terms of reflection of market action today, because they haven't manifested into, positive growth in sales and earnings to attract that marginal student candidate who's deciding, should I subscribe or not? And if you look at their subscription services, which is the majority of their sales, 174 million in sales, 154 subscriptions, those were down 9%. In fact, they were down more than top line sales. So when your recurring revenue portion of your business is down more so on a percentage basis than the total revenue of your business, that's also not good. And I think that's, again, reflective of what we're seeing in the stock.
Yeah, and unfortunately, it doesn't feel like their AI narrative is enough to enthuse investors, because they've been really touting that for quite some time, and we haven't seen it translate into anything.
Right.
So it's not the first time we've talked about their push into AI, but unfortunately today down significantly on the session. Great insights, as always, George Tsilis, Senior Markets Correspondent for the network.